Save money today when you're in a higher tax bracket. Pay money tomorrow when you're in a lower tax bracket. That's what we're told to do.
That's what we're told.
Yep. Jonathan, what's wrong with this picture?
It doesn't always work out that way.
Guess what we're going to talk about tonight?
Your favorite topic, baby?
Oh, yeah. So here we go. I hold in my hands.
Oh, boy.
In my hands. A 56-page report. Jonathan, 56 pages.
5-6. It's
Yes.
it's like half a ream, it looks like over there.
Yes, 56 pages. It says, it is titled Retirement Insights Guide to Retirement for 2022.
It must have all the answers, right?
And yes, it's put together by J.P. Morgan.
Oh.
Yes. Guide to Retirement, 56 pages, everything you need to know about retirement planning.
How exciting.
Now, by the way, I do want to make sure to give them some kudos. They have a ton of great information in here. A ton. Here's my little question, though. Do you think, Jonathan, that maybe, just maybe, that when we think about our retirement planning, we need to think about, well, how are we going to handle income? When should we take Social Security? Right? How should we invest money? Are there any strategies for investing in retirement that are different than when you're working? What about healthcare? Do all those things matter in retirement? Yes or no?
Absolutely, yes.
Yes, they do. And guess what? They've at least touched on all of those.
Oh, good for them. That's fantastic.
Yeah, in these 56 pages, they touch on all of them. Yay.
Yeah.
But there's one thing they don't talk about, and it's one thing that will affect almost every American who saves for retirement, and it's this. If you put money in your 401k, what happens when you pull the money out?
That lovely thing called taxes, right?
Yeah, you got to pay tax.
Yeah.
And do we think that taxes are going to increase down the road?
I would say yes.
Probably.
Probably so.
Yeah, pretty high probability, right?
Chances are.
So here we are. We're going into retirement. Most of our money's in 401ks, 403bs, money that's never been taxed. And as we enter into retirement, we're going to have to pull money out of those accounts. Means we're going to have to pay tax and more tax and more tax and more tax. You know what? Nowhere in this 56 pages do they give you any strategies for reducing taxes during retirement.
You just pay it. That's the strategy, it sounds like.
But you know what? That doesn't surprise me, because let me share a little story with you. I was talking to a very nice couple the other day, and I can't give you their real names here because of privacy, and I can't say I don't know, my favorite TV couple, Fred and Wilma, because that's copyrighted.
Do that. Don't even
right?
say it. Yeah, that's right.
Can't even. I might have just. Who knows? Compliance may have just bleep me out.
Probably so.
But so let's go with our hypothetical couple. I don't know. Let's go with Bob and Shirley today.
I like that. Bob and Shirley. They seem friendly.
I don't think there's any TV couple named Bob and Shirley that I'm aware of, so we'll go with that. So I'm talking to this great couple, Bob and Shirley. And their retirement was basically Social Security and 401k.
Okay.
Right? And they're great people. And he was getting ready to retire in about a year from now. Mm-hmm. And they were concerned, rightfully so, about the taxes that they would likely have to pay in retirement. Now, in their case, they are not big spenders. They live a modest lifestyle, and they have no debt. And they had calculated, said, man, if we could get $5,000 a month to spend, $60,000 a year, we'd be good.
Yeah.
And we were going through the math, and it turned out for them, now listen to this, Jonathan, this is really important. We learned that early in their retirement, on that type of income, at least under the current tax code, their tax liability would be less than $1,000.
Awesome.
Not a big number at all. In fact, they were shocked to hear it'd be such a low number.
Right.
I remember they said, we've sure paid our fair share of taxes over the years. It's kind of comforting to hear that we may not pay much when we're retired.
It's about time, right?
Yeah. And so then we looked down the future, and down the road, 20 years down the road, when they're like 80, right, in their 80s, maybe they would pay like $1,600.
Okay, so still not bad.
Again, not a big deal, because by that point, because of inflation, they've got more like $80,000 income or something, right? So all of things are tracking really well. Now, the first things, they were working at a big bank.
Mm-hmm.
Their advisor was at a big bank, really good person. And the big bank might be associated in some way, shape, or form with this report from J.P. Morgan.
May or may not be, yeah.
Yes. Anyway, good person they were working with, but they said, we never talk about taxes. I said, well, guess what? It looks like they're not that bad. And they said, that feels good.
Yeah.
And then I asked a question that kind of turned this whole discussion on its head a little bit. I simply said, okay, good. So as long as you're both around, your taxes are going to be next to nothing. How's that feel? They're like, man, that's great. We love it. Like, okay, I got one more question. Do you expect to die at the same time?
Yeah, going out together, off the cliff or something, right?
Yeah, do you think you're going to go out together? They're like, well, we would like to, but that's probably not reality, right? Reality is one of them will probably go first and the other would go later, right? By the way, studies show us that on average, wives, and I honestly don't hold me to this, Jonathan, because I don't remember the source, but I know I've read this multiple times that on average, women, we know they live longer than men.
Right.
And on average, they're living roughly, I think it's 7 years after their husband dies before they pass on. So something 5 to 7 years.
That feels right, yeah.
Yeah, so I might be off a little bit, but I'm sure it's somewhere in that range. So here we go. So we said, what if, what did I call them, Bob and Shirley?
Yes, Bob and Shirley.
Okay.
Yes.
What if Bob kicks the bucket? What if he dies first? Because just so, as you're listening to us, just so you know, when you visit with us, if we ever talk about, if you're married, if we ever talk about someone dying first, we never pick on the ladies.
Wouldn't think of it.
No way. We always pick on the gentleman because, that's the right thing. That's what my parents would have taught me is the right thing to do. Don't pick on the ladies. So, okay, in this case, we picked on Bob. And so we said, okay, Bob, what do you love doing the most? He goes, I love to golf. I said, great. Let's imagine you have the best round of your life. You're on the 18th hole. You sink that putt. You raise your putter in the air in celebration. And the big guy upstairs sends a bolt of lightning down to take you up there to hang out with him.
Right on the golf course.
Right on the golf course after your best round ever.
That's rough.
Right? So anyway, what happens if he dies? Same income need, but now she's a single taxpayer.
Yeah.
Now, we assumed that this is in their 80s. They were, together, they're paying like $1,600 a year in tax. Guess what? If one of them dies, the surviving spouse in the same income would pay $10,000 in taxes.
Wow.
Every year.
Every year.
That's the IRS's gift to the grieving widow.
I was going to say, you mean the IRS doesn't give them a break?
You would think. From $1,600 to $10,000. It was ridiculous.
Goodness.
That is when they sat back like, why hasn't anybody told us that?
Yeah.
Well, I mean, gosh, do you think that their financial advisor at the big bank, do you think that advisor's had clients die from time to time? Yes.
Yeah.
They have an accountant. Does their accountant have clients die from time to time? Yeah. So why doesn't anybody tell them? I'll tell you why, because nobody does tax planning. Nobody does tax planning. Tax planning is saying, hey, here's where we are today. Let's look out into the future and let's see where we're going. Mm-hmm. And are we okay with where we're going? In this case, they were okay as long as they were both around, but not if one spouse passes. Now, the good news is we caught it while they're still around, so we can do something about it, right?
Yeah, absolutely. You can get in front of it. That's the goal.
That's right. But here's the thing is you're listening to us. What about you? What about you? Are you married? And maybe taxes aren't a big deal for you, or maybe they won't be when you retire, as long as you're both around. What's going to happen to your surviving spouse? Don't you think that's something you should know? And speaking of which, I'm going to talk more about this later. Don't you think it'd be a good idea to know about the taxes that you're projected to pay in retirement?
Mm.
Are you really going to be on a good path? Or are you going to be in worse shape than you think? This is just part of retirement planning. Retirement planning is about making sure you're stabilizing your income. It's about protecting the risk on your investments. And it's about protecting the risk against taxes and maybe increased taxes. Here's the thing that drives me crazy the most. So here we are everyday Americans, like good, high-quality people. Middle-class Americans, upper-middle-class Americans, they're just saving money. Like, here you are. You're working hard. You're putting money in your retirement account because that's what you've been told to do, right? You're saving money, and you're just kind of looking forward to the day where you could say, man, finally, I've gotten to the point where I'm financially independent. I can go ahead, I can retire, I can do what I'm dreaming of doing in retirement. Maybe you want to travel, maybe you just want to golf, maybe you want to play tennis, maybe you want to hang out with your grandchildren. But you finally hit that point after years of saving money, and you've done everything the way you were supposed to do it. Everybody told you, put your money in your 401k, get that company match, put 10% a year or more in your 401k if you can, and just build that sucker up. And you know what? That's what you want to do, they tell you, because you're making money today, so you're in a really low tax bracket. And when you retire, good news, you're going to be in a lower tax bracket. So that's when you want to take the money out. Save money today when you're in a higher tax bracket. Pay money tomorrow when you're in a lower tax bracket. That's what we're told to do.
That's what we're told.
Yep. Jonathan, what's wrong with this picture?
It doesn't always work out that way.
Yeah, in fact, what we learned, because here's the thing, retirement, if you think about it, what do you have to do right? There's 3 things you must get right in retirement. You have to get this right. You need to have a stable income plan. You need to have a plan where it's easy to understand and it provides stable and predictable income no matter what the stock market does. No income, no retirement. It's that simple. So you got to have that. Next, you need to have a plan to manage risk on your investments. Now, don't get me wrong. You still want your money to grow. So you can't just be putting everything in the bank. But you still have to manage risk. You cannot afford 20% losses anymore or 30% losses. Most people can't afford that anymore. So you have to have a plan in place where you say, okay, if the markets are getting hammered, how do we protect ourselves? But also, how do we still make money when markets are growing? So different type of investing. So income plan and a risk-managed investment plan. Third thing, though, is this. You got to have a plan to deal with the IRS because they want your money.
Your friendly IRS, yes.
Wow. You just said friendly IRS. Now, those of you who are listening to us on the radio, my man Jonathan is he's standing here in the studio right beside Benny, the tax monster.
It's very much a monster, yes.
He does not look friendly.
No, that was said with a large grain of salt, but yeah.
I feel sarcasm from you, Jonathan.
Just a little bit. It might be dripping with it, you know.
So here's the deal, but you got to have a tax plan. You've got to have a tax plan. And that's what we want to talk about this week, because here's the problem. Here you are doing what you're supposed to be doing, saving money in your 401k. This is money that's never been taxed. So we see people retiring. They've got $300,000, $400,000, $500,000 in these accounts that have never been taxed. Or, holy cow, how dare you have done a really good job and you have $1 million or more in these accounts. Oh my God, how dare you? Because then, if you've really done a good job, if you've got over $1 million, it's like the IRS is like my Australian Shepherd dog, Rocky. When I've got I'm at dinner, I've got a nice steak in front of me, and there's Rocky sitting right beside me, drooling.
Yeah, some of it's his, right? That's what he's telling you.
As far as he's concerned, yeah, and you know what? As far as he's concerned, it all should be his.
Yes.
That's the IRS.
Yeah.
Right? The IRS is your drooling dog when you're having dinner saying, hey, gimme, gimme, gimme. Right? Mm-hmm. The difference is that with your dog, at least with my dog, I get to choose how much I give him. But with the IRS, oftentimes they're the ones telling you
that's how it works.
How much you give them. Right? Imagine that. Imagine my dog Rocky getting to choose how much of the steak he gets.
Yeah.
I don't think I would appreciate that.
Not at all.
I wouldn't have any steak, right?
Right.
But here's the thing. So here you are. Let's say you've got $500,000. You might have more, you might have less. $500,000 in your 401k. And here's the thing that a lot of people don't understand. Now, everybody's different because taxes are different for everyone. But for a lot of people, if you have, say, $500,000 in your retirement plan, guess what? Over your retirement lifetime, there's a pretty good chance that you're going to be giving the IRS roughly $500,000.
Doesn't sound right.
Which means that you get the earnings, but they get the principal.
Yeah.
Or something like that over time, right? But here's the better news. That's what you do. That's what you give them if you just sit back and take it.
Right.
The good news is that there's this thing called the Internal Revenue Code, which is like 40,000 pages or something,
Just
right?
a few, yeah.
It's ridiculous. But the good news is, in black and white, they tell you what you can do about it. It's just nobody tells you what the Internal Revenue Code says, right? So it's kind of like this. I heard a big CPA firm, they said this, and I don't know, again, if these numbers are 100% accurate, but it wouldn't surprise me if it's close. They said, this is what they said. They said, about 10% of the tax code is about telling you, here's how much you owe. The other 90% of the tax code is, here's how you can reduce that number. The problem is things like, the other 90% of the code is not fun reading. Nobody wants to do it. And, unless you're a CPA and you're helping businesses save millions of dollars. But what if you're getting ready to retire and you got $500,000 in your 401k? Is a CPA going to read the tax code to help you figure out how to save your taxes?
Maybe not. Probably not.
Not so much, right? But that's the world we live in. So we're really good at this. So Roth conversions is an option. Maybe doing donor advised funds can help there. Maybe doing QCDs can help there. Maybe you could do some kind of charitable trust. There's a lot of different things you can do to help reduce taxes on your 401k. And for a lot of people, it's not unusual. Hey, you got $500,000 in your IRA or your 401k. You're going to end up, if you look at taxes in the future, you're going to give the IRS about $500,000 over time. Assuming taxes don't go up, by the way.
Yikes, yeah.
If they go up, it's going to be a bigger number. It's very common that we can save people over $200,000 of tax in a scenario like that.
It's incredible.
I had one the other day. Someone they had about $1.3 million in their 401k. We saved them over $400,000 of expected tax, tax over their expected lifetime. Right now, in other words, we said, hey, they thought they'd live to about 90. If you live to 90, here are your taxes now. It was like $1.3 million. And by just simple planning, we were able to show them, look, with some simple planning, instead of giving the IRS $1.3 million between now and age 90, you can make it more like $850,000. And by the way, that was just getting started.
Right, yeah. That was
just starting.
That was the simple analysis, yes.
Yeah, there were other things we could do. So my point is this, and I go back on the show here all the time. What about you? What about you? When's the last time you sat down with your financial advisor and had a conversation about how you're going to save taxes in retirement? And do you do that every year? Do you sit down every year with your advisor, whether it's your CPA, accountant, financial advisor, and say, hey, here's how you save taxes in retirement? Do you have that conversation every year? I'm betting you don't. I remember, Jonathan, when my dad retired back in 1999.
Yeah.
Way back in the day. And I remember when he retired, he came to me, he said, hey, Mike, I want to retire. I know that's kind of what you focus on, and I want your help, right? I'm like, I'm on top of the world. Yeah, I'm so brilliant. Yay, me. I'm favorite son right now, right? Dad's coming to me for help. And he said to me, he goes, Mike, here's what I want. I want you to help me do 3 things. Now, listen to what my dad told me. He said, number 1, protect my principal. Yeah, I've been working my whole life. I've been working 32 years. I've been saving this money. It's all I've got. I want you to protect my principal. And at the time, he had like $300,000, right? So my dad's not like some millionaire,
Right.
Protect my principal. Number 2, give me some income. Right? Well, yeah,
That's needed in retirement, right? That's the name of the game.
So far, so good. How much retirement, Dad? Well, I'm thinking I need about $1,000 a month. That's $12,000 a year. I got $300K. That's about 4%. I've read that's a number that seems to make sense. I'm like, you got it, Dad. I got this. I know how to do this. He goes, okay, number 3, I want you to help me grow it a little bit. Protect my principal. Give me some income. And grow it a little bit for inflation. Now, what do you think? Is my dad asking anything unusual? I mean, isn't that what most people want with their retirement planning?
Most people would say yes. I'd imagine, yeah.
It's exactly what we want. Yeah, that's what we all want. But then, and by the way, I knew how to do all that stuff. At least, I'm going to take a step back. At the time, I thought I knew how to do all that stuff because the industry had an answer for that. And by the way, the industry's answer was 100% wrong. But, and I learned that later, but that's not the purpose of this story. Then my dad throws me a curveball. He says, oh yeah, one more thing. Like, what's that, Dad? All this money's in my 401k. I haven't paid tax on any of it yet. So if you can figure out a way to help me with the taxes on this so I can keep more of it and give less to the IRS, that'd be really cool. Now, I have to be honest. Back in 1999, 1998, I had no idea.
Yeah.
No idea what to do about taxes. None. But I told him I'd look into it, and that wasn't my world. The industry didn't teach me about taxes. They didn't care. You know why they didn't care? How much does, the financial industry get paid to help you with your tax planning?
A fat zero, I believe.
It's a big fat zero.
Yeah.
In fact, tax planning, which is good for you, is often a disadvantage to the financial industry. I mean, think about it. If you want to do a Roth conversion, you want to convert $100,000 from IRA to Roth IRA, you pay tax on that $100,000.
Absolutely.
Let's say you pay $20,000 to the IRS for taxes. How much do you have left in your account?
80.
Does the financial industry want to manage $100,000 or $80,000?
Exactly. That's it.
They want the bigger number. They don't want you to do financial planning. It hurts their profit margins. But you know what? We're not in this show to talk about what's good for the industry. It's about what's good for you, right? So here we are. We're talking about taxes. So my dad, 401k, I didn't know what to do at the time.
Right.
Here's how I learned about what to do. And I want you to listen to this. So this was back in maybe 2006 or something, right? So it was over 20 years, about maybe 2002, is 15, 20 years ago. I had a client who was he worked at General Motors, and he was retired, and he was an ex-engineer. And I don't know what you know about engineers, but they do tend to be a little analytical.
Just a little bit.
Just a little.
Spreadsheets and such, yes.
And this guy loves spreadsheets. Now, by the way, I also love spreadsheets.
Yeah, absolutely.
I'm a recovering
yes.
analytical type person.
I'm not even sure it's recovering, but we'll go with that, Mike.
Thanks very much for that, Jonathan. So this guy, we'll call him Steve. He had about $500,000 in his IRA. And he didn't necessarily need the money right then. He was like 62 years old. He was retired. And his plan was he was just going to take the required distributions. So for him, that's how it worked at the time. Obviously, you may be different. But anyway, because he's a spreadsheet guy, he had nothing to do one day. So he sits down, opens up his Excel spreadsheet, and he starts typing in, hey, I've got $500 in my IRA, and let's assume it grows at 5% a year. And then let's assume that I only take out just the minimum, and I'm probably not going to need it, so I'm just going to reinvest the difference, and that'll grow. And then when I'm dead, whatever's left over goes to my wife and then my kids. And he was trying to answer the question, how much tax he would owe.
Yeah.
Right? On a $500,000 IRA, how much tax would he owe? Given that scenario.
Sure.
And assuming he lived to like 85 or something, right? And so he did that spreadsheet. He didn't like the answer. So he did it again. Didn't like the answer. In fact, he told me he erased the whole thing, started over from scratch. And he kept getting the same answer. So finally he calls me up and he says, Mike, I want to come talk to you. I got the spreadsheet. I want you to look over my shoulder, and I've got to be messing something up. I've got to be screwing this up somewhere. Help me. Just give me a second set of eyes on this thing. So in he comes, right? And, he brings out his spreadsheet, and we go over it. I mean, we spent like an hour or two going over the spreadsheet, like almost line item by line item. I'm just making sure everything was right. And we're going over this spreadsheet, and here's why he didn't quite believe what he was seeing. Because when he went through and did the math on his spreadsheet, he learned that between, let's see, he and his wife would have to pay taxes each year when they're forced to pull money out in that required minimum distribution. Mm-hmm. Retirement accounts, the only account out there that forces you to pull money out whether you want to or not. And every year it increases. So that was happening, right? So he's paying tax on those dollars. Then he's like, hey, I'm going to reinvest this money because I don't know that I'll need it. It's probably going to be like if I need it for, healthcare or something. When that money grows, I'm going to pay a little bit of tax on that each year. And he did, and he was not aggressive in that number, by the way. He was actually giving himself, assuming he's going to be a smart investor and be more capital gains than anything.
Yeah.
Right? And then he's like, okay, after I die, my wife gets it. There's no taxes there. But after we're both gone, the kids get whatever's left over. They got to pay tax.
Mm-hmm.
So when he added up all the math for him, now it's different for everyone, but for him, he added up and guess how much tax his $500,000, he's got $500K in an IRA. Jonathan, over his lifetime, how much tax do you think he has the IRS collecting, assuming tax rates stayed the same during his entire retirement?
I don't even know if I want to hazard a guess, but it's high. I mean, I would guess in the tens, if not hundreds of thousands.
Over $500,000.
Over $500,000.
$501,000.
So we're talking about basically the balance of the account itself.
It was terrible. He's like, this is dumb.
All of it.
He's like, based on this, I'm going to have to give all of this to the IRS plus $1,000. And I had to remind him, I'm like, now, Steve, remember, though, this is over like the next 25 years or something. He's like, still
painful.
This is ridiculous. And then here's what he did, though. He said, you know what, though? Based on my math, I can convert this to a Roth IRA. Yeah. I could do it all at once. I could do it over a few years. I could do it over 20 years. And he goes, I've done some simple math. It looks like if I do this over the next 3 years, if I just chunk it down and do it over 3 years and get it all converted over 3 years, I only have to give the IRS like $120K.
Huge difference.
So he goes, I'm trying to figure out how this is not a no-brainer to do. I would save like $300 and some thousand dollars.
Tell me I'm wrong, right?
Tell me what I'm missing.
Yeah.
I mean, it can't be this easy. And I'm telling you what, at that time, by the way, I actually had a CPA in my office already. Actually, he worked for himself, but he was officing with me. Mm-hmm. So his name was Steve also. And I said, hey, Steve, CPA Steve, can you come double check our math?
Yeah.
And he's sitting there. He says, yeah, you're exactly right.
Wow.
And you should do those Roth conversions. That's when I learned that a simple way to save taxes is Roth conversions. Now, by the way, is everyone's tax situation different?
Of course.
Yes.
Yeah.
So just because that worked for my client Steve, does that mean it works for you? Would you save as much as Steve, or maybe more, maybe less? I don't know. My point, though, is, are you sitting down every year and looking at it? I am going to give you a couple of situations. One's it's more frequent.
Okay.
The other is a little more rare, right? But this is where I've had clients end up being able to do Roth conversions. It's cost them nothing.
Wow.
Which is really cool, right? So here we go. Number one, couple comes into the office, great couple, and they're just cruising right along. And I asked them, one of the questions I like to ask people is, are you charitably inclined? And they said, well, we do give to our church. We tithe to our church, right? Mm-hmm. So how much would you say you give the church every year? And they said, well, we tithe, and we make about $10,000 a month, so that's, I guess, what is that? $12,000 a year.
Yeah. Yep.
Right? $1,000 a month, $12,000 a year.
That's it.
So, okay, great. How much of that do you get to deduct on your tax return? Well, these days with the standard deduction, that it's much higher.
Yeah, it's sizable.
Yeah, basically they had property taxes, but their house was paid for, and they didn't really have any medical. They actually didn't itemize at all, which meant basically they didn't get to deduct it.
Right. That's fairly common too.
Yeah, it happens all the time. I said, well, what if we did this? What if we took this $12,000 you give every year, and they had some money. This couple actually they work for Apple, They had a lot of money. People who work for Apple seem to always have more than they should in Apple stock.
Yes.
And it's highly appreciated.
Yes.
I said, well, what if we took like a chunk of this Apple stock? What if we took, I don't know, maybe 50, 60,000 of it, and we'll gift it. We're not going to have you cash in and pay the tax on it because we want, it's a lot of gains.
Yeah.
What if we just give it to something called a donor advised fund? And by doing that, you get a tax deduction this year for the full amount you give. So let's say they gave 60,000, 5 years of giving. They put in 60,000, they get a $60,000 charitable deduction up front. And then, right, what do? Each year, instead of them giving their charity $12,000 or $1,000 a month, they're just going to have the donor advised fund make that contribution for them. So they're still giving to charity. It's just they're lumping all their giving for the next 4 or 5 years in one lump sum. So that way they can deduct it.
They can capture that, in 1 year.
Yeah.
That's really cool.
Guess what happens when you do that? You create a tax deduction. Then they turned around and they rolled 50,000 of their Roth IRA or IRA to Roth IRA, and they're like, oh, we owe tax on that, right? Not anymore.
Oh.
Because they had the deduction from giving to the donor advised fund.
It's a wash.
Yeah, and I know I covered that pretty fast, but here's the thing. If you're giving to charity, is your advisor talking about donor advised funds? And if they're not, why not? Because this would be a way that you can both give to your charity, but use that giving to potentially do some Roth conversions for free. That's a good one, right?
That's fantastic. Yeah, that's a good one to have in your back pocket.
Here's another one for you. Here's a question for you, Jonathan. How many people start a business and then fail? Like for every 100 people that start a business, how many of them fail?
Lots of them, unfortunately.
Yeah, they say like over a 5-year period, like 80, 90%.
Is it that
fail.
high? Yeah, I was going to say probably over 50%. But
huge number.
Yeah. It's
Well, here's the deal. When you're starting a business, a lot of times you're plowing money into it.
Mm-hmm.
And if it fails, guess what you end up with? You have losses on your tax return. I had a client come in. One of the businesses he started is he invested in this oil and gas thing.
okay.
Right? And by the way, that's a business.
Yeah.
It wasn't a real business for him. He was investing, but he was a general partner. And a lot of these oil and gas things, you're a general partner. So he found when he did that, he invested he did like $500K. He did a big number.
He went in. Yeah. Okay.
And because he's convinced this was it.
Taken off. Yeah.
And way more than you should have put in there. And guess what? It went kaput all the way to zero.
Wow.
So he's sitting on a $500,000 loss. But guess what he was able to do? Convert $500,000 of his IRA to Roth IRA for free, offset the entire amount with the loss he got from that business investment.
So bittersweet, but at least it's not a total loss, right?
Business got crushed, and he put way more money in than he should have, right? What happened was he inherited the money. He's like, he got it from his dad. His dad was a big oil guy. He's like, I'm going to put it in this project.
Yes.
We're going to be just like that. And then he lost all the money.
The emotional investor, yes.
Yeah. And so anyway, it stunk. But because he had that loss on his tax return, we were able to convert 500 of his IRA to Roth IRA, and they washed. And so one led to income, but the loss offset it. And so, you know what? That's at least better than a kick in the pants.
Yeah, absolutely. Right? Absolutely.
I've had this happen. People who are retired, and they're, for at least a short period of time, in a super low tax bracket.
Yeah.
Right? I've seen them be able to convert IRA money from IRA to Roth IRA literally tax-free.
In that, yeah.
Not huge chunks, right? But as long as they stay within the parameters, tax-free.
Yeah. Take advantage of those few years, absolutely.
Yeah, people have big health care expenses in a year, right? Maybe huge deductions. Maybe we can use that to convert to Roth IRA, tax-free. A lot of different ways to do this, but guess what they all require? In every one of these, you have to pay attention. You have to have someone who is helping you look at your tax planning each and every year. And how many people actually have that?
Very few, unfortunately.
Yeah, I mean, it's a big part of retirement planning.
Huge.
So here we go. I know we're getting to the end of the show. I don't want you to miss out on this. So here's the thing. when it comes to your retirement, if you're already retired or if you're nearing retirement, there are 3 things you must get right. You must have a plan to provide stable and consistent income. No income, no retirement. If you want to retire well, make retirement the best time of your life, you've got to have an income plan. Second, you have to be able to manage risk effectively with your investments. That means when the markets are going well, you want to make money. But when the markets are not going well, you got to be able to protect yourself. No longer can you likely afford 20% losses or more. In fact, guess what? You probably can't even afford 10% losses or more in a lot of cases. And then third, so you got to have an income plan, got to have an investment plan. Third, taxes. How are you going to protect yourself from the IRS? What are you doing every single year when you talk to your advisor to help reduce your taxes over time? Right? What are you doing? How's that conversation going? If you're not having it, in our opinion, you need to have it.
Yeah. There's your sign, right? I mean,
yeah, there's your
time
sign.
for a
right?
change. Yeah.
Yeah, who says that? Bill Engvall, right?
I didn't mean to steal a line or anything.
There you go. But there's your sign. Here's the point. If you don't have any one of those 3, much less all of them, you might say, Mike, I don't have any of those things.
Yeah, right.
Or maybe my advisor just really talks about the investments and says, don't worry, you'll be fine.
Yes.
Guess what? Probably that's a danger sign. So here's what we're doing. As long as you've saved at least $200,000 for retirement, you need to call us now. You absolutely don't miss out on this. Pick up a phone, call us. Let's have a conversation. Jonathan, let's give that number out one last time tonight.
All right. The number is 512-886-5850. After hours, so you will get our answering service. We'll get your name, number, and a good time to call you back. Again, the number 512-886-5850. Give us a call.
That's right. Listen, now is the time, right? The markets are in turmoil. Now's the time. Let's take advantage. Let's get this roadmap put together so you can retire well and enjoy what should be the best time of your life. That's our show, folks. Hope you have a great night. We'll see you again or talk to you again next week.